Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, December 23rd, 2023. How you doing? I appreciate you coming and watching my weekend review podcast. I hope it's going to be helpful for you. I hope you had a good trading week. We're coming into the last trading week of the year. I hope it's been a good year for you and you've had some good trades. And I really want to wish everyone happy holidays and all the best health, wealth for the coming new year. So, the format today, this is what this podcast is about. First of all, we are going to run the U.S. legal disclaimer. Secondly, we are going to come back. We're going to take a look at all the trades I made last week, both on the daily and the weekly time frames. We are going to talk about when I entered the trade, why I entered the trade, what the setup was, what my thoughts were of why I entered the trade, and most importantly, then, how I am going to manage the trade going forward, either to the upside or to the downside. It's very important in trading, at least the way that I trade, is that I look for levels that are rejected by the price, significant levels like a 200-day moving average, 250, 300, a 30 RSI. And I look and ideally for multiple levels to be rejected at the same time that will give you a very good risk to reward ratio and a line in the sand to plan your trade around. You really need to plan your trade around a level. And so if that level is rejected, enter, and then position size based upon your account value and the volatility of the market. I'll show you how I do that a little later on in the podcast. And then placing two stops, an emergency stop, so that if you're really wrong, you have a defined risk, you know how much you're going to lose, and it's a small percentage of your capital. And then an end of day stop or an end of bar stop, so that if that level that was rejected is rejected again, but to the downside, that you simply get out for a small loss. And then if it moves up, knowing how to manage that trade up to certain levels, tightening up your stops, taking partial profits along the way. So basically, what I'm going to try to show you is the process that I use. But whether you follow my process or someone else's process, you really just need to have a process that you can follow, so you don't have to make guesses, so you don't have to have opinions, that you just follow the process. If it does this, I'm simply going to get out. But if it does that, I'm going to do this. So if then statements. If it does this, I'm going to do that. If it does that, I'm going to do this. And really, that's what trading is about. Rejection of a level, and then getting out quickly if you're wrong. And if it moves your way, knowing what to do with it, even if it moves up dramatically. But at the end of the day, that's what trading is about, a good risk to reward ratio. And if you're wrong, being wrong small, and if you're right, having the potential for a big gain, because you need those occasional big gains to pay for all the inevitable losses, I promise you, that you're going to have. But you just have to be very patient with your winners and have that process, and you have to be very impatient with your losers. That's it. That's really it. Okay. So we'll take a look at all the trades, why I entered, how I'm going to manage the trade going forward, both on the daily and the weekly time frames. And you'll see through this podcast, I don't have all winners, but when I have but if I'm in a trade for a long time, it's because it's profitable. If I'm out of a trade, it's usually very quick. I'm out, and that's it. About keeping those losses small and then being patient with those winners. Okay, so after we go over all the trades and what I'm going to do with them and how I'm managing them, we're going to do a little bit on trader psychology. Trader psychology is the most important skill in trading. You always hear about, oh, he's a skilled trader. Well, or she is a skilled trader. If they're a skilled trader and they're successful, I promise you, one of their greatest skills is the ability to have that process and following it and having the strength to get out when their system tells them to get out, and alternatively to stay in the trade if it's going their direction. Okay, so it's always helpful for me to teach trader psychology. I hope it's helpful for you, but it is such a massively important part of trading, the ability to have the discipline to follow your rules. Okay. After that, I have gone down through my master watch list, both on the daily and the weekly charts, and I have identified some trades for next week that are interesting to me. Now, they're not going to probably be where they need to be, otherwise, I would probably already be in the trade. But I really like to, on Friday nights, is kind of my routine, but on Friday nights, I go down through every single stock in my watch list just with a fine tooth comb, and I say, okay, where are some levels that I would feel comfortable buying these? They're not there yet, but if they get there next week, are there a confluence and combination of indicators levels lining up? If it does get there and I get an entry trigger, then I will consider taking the trade. So I've gone down through the weeklies and the dailies, and I have identified the positions that I'm looking for those markets to get to those levels. If they get to those levels, I will consider taking the trade. If they don't get to those levels, then I'll just move on to another market. All right. So I hope it's going to be helpful for you to kind of get in my mind and look for the things that I'm looking for. So anyway, I hope it's going to be helpful. All right. So let's get started. First of all, I need to run the U.S. legal disclaimer quickly. And so hang tight for about 40 seconds, 42 seconds, and I will be right back. Thanks a lot.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started. I mentioned before, it's very important when I look to enter a trade that I find a trade that has the most confluences or combinations of indicators lining up at the same time. It's gonna, if you have multiple signals, it's going to increase your chance to have a profitable trade. It doesn't have to be profitable, but it will help increase the chances and the odds, and of course that's what we're looking for. But again, I'm looking for a confluence combination of indicators lining up. Then I need to position size based upon the account value that I have and the current volatility of the market. And then that tells me how many shares to buy. Then I place an emergency stop 2 ATRs below. I have an end of day stop, and then I have a process to take profits if it moves my way. If it gets to a certain level, 1.5 ATRs above my entry, then I go into a trailing stop mode. But this is what I'll show you. I have different types of trades here, but this is what I'm going to show you. Let's start with Caterpillar. Well, I was fortunate enough to buy Caterpillar all the way back here on the 1st of November. Why did I enter Caterpillar? I want you to take a look at the orange line here. This is the 300-day moving average. This is a major level that advanced traders and large financial institutions will key their trade off of. And this is called the deep dip buy stock. This is a deep dip buy stock trading strategy entry that I took. And deep dip buys are one of my very favorite ones. One, they're low. I like to buy stuff low. But take a look at the orange line. This is the 300-day moving average. The day before I entered, we closed under. And then the day that I entered, we closed over. That just by itself is a legitimate entry signal. But what also happened, going back to confluences, combinations of indicators, the RSI level the day before was under 30 RSI. And then the day of entry, it closed above 30 RSI. So those were my that was my combinations of signals. A close under 300, over 300. That by itself is legitimate. The day before, it closed under 30 RSI, over 30 RSI. That by itself is legitimate. But you see how I had both of them. All right. So that's my entry signal. And as soon as I enter, or as soon as I see the signal, I have to decide how many shares I'm going to buy. And the formula that I use, it works with any amount, but let's just use a hypothetical $100,000 trading account. If we have a hypothetical $100,000 trading account, we take 100,000 times 1%. How much is that? It's $1,000. So what I'm going to do, I'm going to take that 1% of my total trading capital, $1,000. I'm going to look to the value of the 2 ATR. ATR means average true range. This is 2 ATR means it's twice as much as it's likely to move. A 1 ATR is what it is supposed to move. 2 times this is way outside of where it should move. So that is what I'm going to use for my emergency stop. So the value at this moment right now is 1089. So I would take $1,000 divided by 1089. That would, based upon a $100,000 trading account, it would basically tell me to buy 91.8 shares, or round it up to 92. That is the correct amount to buy. Now, if I had $1 million, 1% is $10,000. Same thing, $10,000 divided by 1089. That's going to tell me to buy 918 shares. So it's just a function of your total trading capital. So back to the $1,000 divided by 1089 tells me to buy 92 shares. Now, I have the signal, I have the confluence of signals, under 30, over 30, under 300, over 300. Then I buy my shares, my 92 shares. Okay, now, first thing I want to do is I want to place my emergency stop exactly the value of 2 ATRs below my entry. This is the red line. If it gets down here, I have 92 shares that moved 10.89 points. That's going to be my emergency stop, and that's my emergency stop. If it gets there, I'm totally wrong. I've lost $1,000. That's only 1% of my capital. Not fun, but I can recover. Now, your emergency stop is only going to be hit about 5% of the time, in my experience. The other 95% of the time, if you have a loss, it will just be your end of day stop. Now, why did I take the trade? Because it closed under 300, over 300. Therefore, if it in the future it closes under the 300-day moving average, even by a penny, I'm simply out for a very small loss. Okay? Now, I have an orange line. The orange line is 1.5 ATRs above my entry. Emergency stops 2 ATRs below. Trailing stop level 1.5 above. And if it moves to that 1.5 level, then I go into trailing stop mode, which means if I have a close below a previous bar's low after reaching trailing stop level, I get out of half of the position, because if you have a close below a previous bar's low, it's kind of an indication that you may be heading back down. Okay, now lastly, I always take partial profits if the price moves the value of 0.45 ATRs, right now it's 2.10, from the previous bar's close. So let's just go to current price right here. We're at 290.36. That's the previous bar's close. So 290.36, and the 0.45 ATRs right now, real time, is $2.45. Okay, my first profit target for Tuesday, I guess it is because of the holidays, is 292.81. That's the current price, current closing price, plus 2.45. 292.81 is my first profit target. And then I take my first profit target, which is 292.81, and I add the 0.45 to it again. That's going to be my second profit target for Tuesday. Then I take my second profit target, add one more time, plus 245. That's my third profit target. And so if on Tuesday, it gets to any of those profit targets, I will take off 10% of the remaining shares that I have. Okay, so what that allows me to do is to take partial profits on strength. So here's the setup. Under 30, over 30, under 300, over 300. I position size correctly. I place my emergency stop 2 ATRs below. My end of day stop is simply a close below the 300-day moving average. I place my 1.5 ATR trailing stop level above. Next day moves up. I take a little profit off. And by taking a little profit off, what am I doing? I'm reducing my position size and I'm reducing my overall risk. It's just by default, I'm upping my trailing stop levels just by taking stuff off. It's important in trading that you play defense. It's very important with your stop losses, trailing stop levels, all that kind of stuff. But you also have to play offense, and the offense is the taking partial profits into strength. All right. So let's take a look here. See if I can give you a little better view. Okay, so I enter. Next day, moves up. I take a little profits. Next day, moves up to my trailing stop level. Now it means if I have a close below previous bar's low, I take half. Go down, go down. Unfortunately, this bar here did close below the previous bar's low, and I sold half of my remaining position for a gain of 1.31%. Okay? Now, in this case, do I wish I would have held all of it? Yeah, of course, right? But it just doesn't always work out. But at least I kept half. That's the best thing with selling half in the stock market and with your trading. If you sell half and it goes up, you're still happy that you have half. If you sell half and it goes down, you're happy that you got out of half. It's one of the only win-win situations in trading. So, get to trailing stop level, have a close below previous bar's low, exited half for a gain of 1.31%. And thank goodness I held half, because look what we did. We moved up, taking partial profits along the way, taking partials, had a little bit of a pullback, and then we just moved up like crazy. Continue to take partial profits, Now, we are up into the 78 range on the RSI, which is just out of control. Now, if I would have rejected the 70 RSI, I would have sold half of remaining. If I would have had a close below a previous bar's low after rejecting the 70, I would have been completely out of the position. But none of that happened. We just kept moving up. Now, you see the line here, the little blue line, the thin blue line. This is the 5 EMA. We are at a 78.59 RSI. If I ever get to 65 RSI and then I close below the 5, I am simply out of the trade. Look, right now, in the future, next week, if we close below this 5 EMA, I'm simply out of the trade. And you may be thinking to yourself, my gosh, there's so many rules here. Yep, I have a lot of rules, but every rule I use has a purpose. I've been trading for 28 years, and I mean, I live and breathe this kind of stuff, right? I mean, I'm obsessed with trading. This is what I do. This is how I make my living. And every rule that I have here, there is a reason, an important reason for it. And that's why if I close below this 5 EMA, makes complete sense to be completely out of the trade. So if you're new to this channel, you may think, my gosh, he has so many rules. I just wanted to let you know that, if you really want to learn these rules, I have a couple options for you. One, I have a very good online trading course on udemy.com where I teach you the deep dip buy stock trading strategy. It's very affordable. The link's in the description of the YouTube channel. It's 9 hours of video, and it's a great, very affordable course. On the other hand, if you'd like to study one-on-one with me, I do teach private one-on-one lessons in the evening time via Skype. I've taught people from all over the world for many years, from absolute beginners all the way up to hedge fund managers, and I do teach a 15-hour one-on-one course. I'll talk more about it later in the podcast, but if you're interested in studying with me one-on-one and having me teach you all of this on a one-on-one basis, it's a great course. And it's a great investment in yourself if you want to learn about trading. And my email is in the link of the description here if you want to reach out to me. All right. So currently, the remaining shares that I have on this position are up 20.16%. And I just want to go back and show, look what my risk to reward ratio was. If the next day it had simply closed below this orange line, I would have been out. But does that make sense? Why you look for the levels, you look for the confluences of signals. If they fail, you get out quickly. If they're correct, this doesn't happen all the time, mind you, but if you're correct, look at this. Look how much of a gain I've made on this trade with starting out was a very, very small risk to reward ratio. This is what trading is all about. So remaining shares here on Caterpillar up 20.16%. Walmart, next trade on the dailies. All right, well, I bought Walmart all the way back here on the 12th of December. Why? What was the signal? Well, look here at the purple line. The purple line is the 250-day moving average. The day before we closed under. The day that I entered, we closed over. There's my line in the sand. Any close below this 250, I am simply out of the trade. So I position sized here. I placed my emergency stop 2 ATRs below. My end of day stop simply a close below the 250. My trailing stop level here is the orange line. Next day, right away moves up. I took some profits off. Then we pulled back for a couple days, but we stayed above the 250. We moved up again, took a little more profits off. Now I'm in trailing stop mode. A couple days later, we have our first close below a previous bar's low after reaching trailing stop level. I sold half of my position for a gain of 1.53%. Next day was a sideways motion day. And then Friday, we had a nice big move up, took some more profits off. The remaining position that I have on Walmart currently up 3.36%. Oil. All right, here we go. And hey, by the way, everybody, if you are enjoying the podcast, if you're learning something of value, I really would appreciate it if you could hit the thumbs up button. Really helps out the channel. So if anything valuable here for you so far, give me a thumbs up. I really, really appreciate that. Thank you. Okay, USO, oil. Well, you see I have the highlighted blue box here. This is what is called an abandoned baby. An abandoned baby happens when you have a gap down. I'm sorry, not abandoned baby, island reversal. Abandoned babies when you have one bar. Island reversal. We have a gap down. We have one day sideways, and then the next day, boom, gaps up. So there was a big change in sentiment between here and here and here and here. And from my experience, these sudden changes in sentiment are followed by a move up in the direction of that change in sentiment. So here was the abandoned baby. I didn't buy right away. I could have. But a lot of times when you have these the island reversals, you will come back and test the high of that island reversal. And that the next day it did. I got long here, 66.02. Now, on abandoned babies and island reversals, I don't phase out of these. It's just kind of a set it and forget it. And so I entered here long at 66.02. I placed my stop on this trade. I'm either going to hit my profit target or I'm going to hit my stop on this trade. But the key is that my stop is 2 ATRs below and my profit target is 4 ATRs above. So it's a 2-to-1 risk to reward ratio. It doesn't mean I'm going to have to, this one is going to hit my profit target, but what it means is I'm risking 2x to make 4x, which is proper trading. So it's either going to hit my profit target 4 ATRs above or my stop loss 2 ATRs below. So that's it. Just to set it and forget it. This particular trade at the moment, based upon this island reversal, up 3.83%. Alibaba. Boy, I have a whole lot of variety of different kind of trades here this week. All right, Alibaba. I got long here at 72.30. Why would I get long here? It's not a deep dip buy. This is a bullish market structure change to the upside. Actually, so here we were down, we were going down, we were going down. Here's one level of liquidity. We ran the level of liquidity here. On this day here, we took out the first pivot point to the upside. This changed the market structure to the upside. And when you change the market structure to the upside and you keep going, you will have this fair value gap. This is ICT teachings. You can look up ICT on video, but this is called the fair value gap. So we have a level of liquidity. We run the level of liquidity. This bar here takes out the first swing high to the upside. This changes market structure to the upside. And then here's a gap from the low of this bar to the high of this bar. Anywhere in this gap here, I guess I should have, there we go, in the highlighted blue area. When you change market structure, strangely, usually you have a little bit of pullback into the gap, and then sometimes it just takes off from there, and that's exactly what happened. So my emergency stop here is 2 ATRs from my entry. Now this one is not a either I make two, lose two, or make four. These ones I am scaling out of here. But my stop, my stop on this trade is if we get down here. Other than that, if it moves up, I'm just going to take partial profits as normal. So we have a level of liquidity. This bar changes the market structure. We pull back. I got long here at 72.35. My 1.5 ATR trailing stop or level is above here. If it moves up, I take partial profits. So I bought here at 72.35. Next bar up, had a big move up. Took a little profits off. Next day down a little bit. And then on Thursday had a huge move up, took more partial profits off, and now I'm in trailing stop mode, which just means if I have a close below a previous bar's low, in the future I will sell half. If it continues to move up, I'll just continue to take profits. If we get to a 65 RSI level, then the 5 EMA will come into place. If we reject the 70 RSI, I'll take off half. And then if we have a close below a previous bar's low after rejecting the 70 RSI, then I will be completely out of the trade. But this trade doing very well on this fair return to the fair value gap after changing market structure to the upside. This particular trade up 3.83%. SPY. All right, so I did get short SPY, and this one's a little tough to show, but you see we have the two blue lines here, from here to here. Now, it's hard because this was so long ago, but anyway, I hope you can see this. I'm not sure if you can, but why did I have this channel? Why? Yeah, oh man, no, it's just too much data. Anyway, there is a fair value gap to the upside between 471 and 475.50. Now, anywhere in this fair value gap here is a short, and you can see we've made it in here, but we have not been able to get above it. So I did get short here on the SPY on the 20th of December. Why? Because we reject the top of that fair value gap, and we did create a V1 to the downside. A V1 to the downside means you have a high, you go above the high, and reverse the high from the previous bar's close. I know it sounds complicated. If you'd like to go to my YouTube channel, I have a really good video there that talk about V1s and V2s, and I always talk about confluence, combination of indicators lining up. Well, a V1 or a V2 is an indicator, is a entry signal either to the long side or the short side, which helps improve the chances of your trade being positive. And so why did I get short here on Wednesday at 474.10? Because we rejected the top of that fair value gap, and we did create a V1 to the downside. So I got short here 474.10. You can see I nailed that one. We had a big move down. That was the big move down on Friday. I did take partial profits as we moved down. My trailing stop level, the orange line, because we're short, is 1.5 ATRs below the entry point. So we got there. I hit 2 profit targets on the way down, so reduce the position size. Next day, we bounced back up. And then Friday, we had our first close above the previous bar's close after reaching trailing stop to the downside. So I locked in half for a gain of 0.11%. Not a big gain, but again, I had big moves down here, so I've already reduced the position size, and so I'm up a lot more than 0.11% because of taking the partial profits. Now let's talk about defensive. Where is my end of day stop? Right here, 479.98. That's basically the high way back in 2022. So if we get above there, then that is going to be my end of day stop. And then of course I have my emergency stop, 2 ATRs from entry, right? I need that fail safe. If it gets here, well, in the worst case scenario, how much would I lose? 1%. So anyway, end of day stop is close above 479.98. Emergency stops up here for 485.50. And the remaining shares on this up 0.11% on this short, but again, shows you the importance of taking partial profits when the market gives them to you. And that's really why I like to take partial profits, because it's overall, it reduces your position size, reduces your risk, and tightens up your stop just by default. So this one up 0.11%. Now Google. This is a very good example of why taking partial profits is important. All right, I got short Google back here on the 22nd of November at 138.70. Why? Well, look, this is what's called an order block. This is an up bar move before a change in market structure to the downside. So just a perfect example of a very good risk to reward ratio here, guys, because here we rejected the top of the order block. That's why I got short. I got short here 138.70. My emergency stop 2 ATRs above. My end of day stop simply a close above this high. So it's a very good risk to reward ratio, very close to where it invalidates the trade of 139.36. So I got short here 138.70, placed my emergency stop 2 ATRs above. My end of day stop is just simply a close above that order block. Orange line is my 1.5 ATR trailing stop level below. And so I got short here 138.70. Next day moves down. I take a little profit off, reduce my position size. Next bar, nothing, nothing, nothing. Then we have another down move, take some profits. Now I get to trailing stop mode. So which means if I have a close above a previous bar's close, I'm just going to get out. Next bar down again. Took more profits off, reduced the position size. Next day, nothing. Next day, moved down again, took more profits off. So now the trade's really in the money, and I'm reducing the position size. Here on the 5th of December was our first close above a previous bar's high after reaching trailing stop level. Fortunately, that rule got me out of half of the remaining shares for a gain of 6.25%. So, now we're up higher. Am I glad that I followed those rules? I really am. Then we moved up, didn't close above 139.36. Then we moved down again, took more profits off, down again, took more profits off. On this day, on the 14th, took more profits off. So you see how I'm reducing and reducing and reducing and reducing my trade to have a smaller and smaller position if in fact it rips up higher. And it did. So on Thursday, it closed above the high of that order block. I had to get out of a loss for a loss of 1.21%. But was it a loss of 1.21%? No, not really. I mean, it was a gain because I took all of these profits off using the offensive part of trading. I locked in half right here near the bottom just because of that entry, or just because of that the rule of taking a high, reducing half the position size because it closed above a previous bar's high after reaching trailing stop level. So all in all, even though the last little remaining part was a loss, overall, this was a really good, profitable short trade. And that's why it's important to play offense, defense, and to have rules. And again, if you don't have rules, find them. I can definitely help you. Like I said, I do teach private one-on-one lessons. I will teach you every single rule that I use, and they're all very important. So this particular, the remaining shares on Google, loss of 1.21%, but overall the position was profitable. All right, so that's it. So recap on the dailies: remaining shares on Caterpillar up 20.16, Walmart remaining shares up 3.36%, USO remaining shares up 3.83%, Alibaba remaining shares up 3.83%. Two of them exactly the same, 3.83, 3.83. How about that? And then SPY remaining shares on that short up 0.11%, and then the closeout position that I had on Google down 1.21%. But if you look at these positions, you'll see that my winners are generally much, much larger than my losers, and we're definitely going to have losing trades all the time. The key is you just need to keep them small. And the key is with your winners, you need to let them run, but you need to have a process to know what to do. So really good trades on the weeklies there. I'm sorry, on the dailies. Let's head over to weeklies. Weekly bars close on Friday, so I make my decision on Friday. I have been in this trade since March 23rd. Not quite a year, but if I've been in this trade for this long, is it positive or negative? It is definitely positive, right? I'm never going to be in a trade for over a year if it's down. I can promise you that. That's the key. So I got long here, XLF financials, 324.23. Why did I get long the trade? Well, purple line here, key level of support, the 250-week moving average on the week that I entered it. It went slightly below, closed slightly above. Or it went below, closed above. Negative third ATR channel here, this gray line, during the week went below, closed above. Well, that's my signal. So I position size, I place my emergency stop 2 ATRs below. My end of week stop is simply a close below the 250-week moving average. Orange line up here, what's that? That's my trailing stop level. If I get to that, then I go into trailing stop mode. So I entered here 30.71. Nice move up, took some profits off. Next week, nothing. Next week, moved up again, took some more profits off, and got to trailing stop level. Now, if I have a close below a previous bar's low, I'm simply going to get out of half. We had about a month and a half of just moving sideways. Then we moved up. Then here on the 23rd of June, we had our first close below a previous bar's low after reaching trailing stop level. I got out of half of the position for a gain of 6.4%. Then we had another little bit longer than a month just up where I continued to take profits. Then, of course, we had the big, huge down move, bump. Here, I almost got me out of the trade on the 27th of October. But you see how we went below the 250 but closed above? That kept me in the trade. Had it closed below the 250, I simply would have gotten out. But you can see, look back in the past, did it respect the 250? It certainly did. Did it respect the 250? It certainly did. And now, I mean, we've just gone straight up. So I took more profit targets here, took more profit targets here, took more profit targets here, took more profit targets here. Whew. We're at a 66.90 RSI. If we close below this 5 EMA in the future, I simply will be out of the trade. So the remaining shares on XLF up very nicely, up 17.76%. But again, look initially what my risk was very small. And a lot of times I'm going to lose on that trade, but I'm going to lose small. But every once in a while you will get these big moves. And that's what happened here. So up 17.76% on XLF with the remaining shares. Johnson & Johnson. All right, I did get long Johnson & Johnson back here on the 15th of December. Why? Well, I always look for confluences and combinations of signals. Look at the black line. This is the 250-week moving average. During the week, we went below, closed above. It rejected that, the 200-day moving average, the black line. During the week, we went below the 200, closed above. That by itself was legitimate. In addition to that, we had a V1, a bullish V1, bar 1, bar 2. Bar 2 washes out, or in other words, goes below bar 1's lows, closes above bar 1's close. So we have an intra-week rejection of the 200 and a V1. I got long here 154.27. Now, my emergency stop is how far below? 2 ATRs. If I get down there, how much do I lose? 1%. What percent of the time is that going to happen? Only 5% of the time. The other 95% of the time, if I have a loss, it's simply going to be a close below this black line, below the 200-week moving average. This week, we went down, tested it again, actually, but I wait for the end of the bar to make my decisions, and we closed above, so I'm still in the trade. I'm still bullish. Orange line up here, what is that? That is my 1.5 ATR trailing stop level. If we get to there, then if we have a close below a previous bar's low, simply going to get out of the trade. So I know exactly what to do with this trade. I don't have to worry about it. I know my worst case scenario. I know my end of week stop. I know I'm going to take partial profits on the way up if it keeps moving up. I know if I get to trailing stop level and I have a close below previous bar's low, I'm simply out. So this is a kind of a new recent trade, but this particular trade so far up 0.75%. So not bad. All right, now I did have a losing trade on Meta on the weekly, and let's go over that now. Okay, I really like this trade to the downside. It just didn't work out, but let me show you. I got short here on the 1st of December. Why? Well, I want to show you, look at the high we have right here with the tall green bars. Then we pulled back, we went red on the MACD bars. Then we went higher, but even though we're higher, see how there's no green bars? This is an indication that we are running out of buyers and that we are going to head down. Now, this one didn't work out as planned, but big picture, even now still, this chart is very bearish. So because of this double top with all these bearish divergences, when we triggered a V2 to the downside, here's bar 1, bar 2 goes above bar 1's high, bar 3, when it got below bar 1's close, I went short here at 334.60. My trailing stop level 1.5 ATRs below. So I got short here, we moved down, took some profits off. I always take some profits when it's going my way. Next week, moved down again. Thankfully, took more profits off. Never got to trailing stop level though, so trailing stop level didn't kick in. Last week, we got, the stop on this, by the way, is halfway of the washout bar, halfway of the washout bar on this V2. Last week, we tested it, failed, kept me in the trade, and this week we just blew right through it. So I had a loss of 5.17% on the remaining shares. But can you see why it's important that I did take some off while the market gave them to me? So not every trade's going to work, right? You can see all the way up here is my 2 ATR trailing stop level. So if I would have gotten up there, how much would I have lost? 1%. As it is, just a little less than 0.5%, even though the trade was down 5.17 from a, if you look percentages of my trading account, it was less than 0.5%, which isn't too bad, and actually a little bit less than that because of taking the profits off. So not every trade's going to work, everyone. I wish they would. Be really fun, but they don't. But the key is just having a process to follow, having a good risk to reward ratio, knowing where all of your levels are. Okay, so recap on the weekly trades. XLF remaining shares up 17.76%. Johnson & Johnson remaining shares up 0.75%. And Meta down, closed out with a loss of 5.17%. Right, but all in all the trades were really, really good, and definitely thankful for that. But you just need to have a process that you follow. All right. Well, hopefully that was helpful for you to kind of get an idea of how I look at trades and risk to rewards and levels and so forth. And let's talk a little bit about trader psychology before we get into next week's trades. This is from Mark Minervini. Mark Minervini, of course, the market wizard, extremely popular and famous trader. And when Mark says something, I would definitely take note of it because it's probably filled with a lot of wisdom. Let's see what Mark has to say. When you learn to cut your losses and fail small, or in other words, have small losses, you stay in the game. If you get to keep playing, sooner or later, you're going to succeed, right? Just probably going to get better. The people who lose the game are the ones who rarely fail, but eventually fail so big that they don't get to play again. So there's a lot to unpack in here. Yes, of course, we always want to keep losses small. Why? So we can keep trading. If we keep trading, we're going to get better. But if you lose all your chips, if you lose all your account, then you are out of the game and you're not going to be able to get better, right? So if you trade small with good risk to reward ratios, good setups, you follow your process, you will, yes, you're going to have a lot of losses. I have losses all the time, but the key is to keep them small. Now, you've probably run into the guy or girl that trades that never takes a loss on a trade or will never get out of a trade unless they're back at break even or better, right? Well, that's their ego. And these people, a lot of the time, about 85% of the time, not adhering to your stop loss, you're going to be fine. It's probably going to go right back up. So that's what he's saying here. The people who lose the game are the ones who rarely fail because they don't adhere to their stops, but eventually they fail so big that they don't get to play again. They run out of chips because 85% of the time, yeah, that stock's probably going to come back. 15% of the time, it's going to turn into the mother of all losses. So keep that in mind. To get better at trading, you need to keep trading. But to keep trading, you need to keep your money. How do you keep your money? By position sizing correctly, and when you're wrong, getting out quickly so you have chips left to keep playing. Make sense? So thank you very much, Mark. I appreciate that. But don't be stubborn. Don't have an ego. I've mentioned this 100 times already in this podcast. Have a process that allows you to have a good risk to reward ratio. When you're wrong, just say, okay, that's fine. That's part of doing business. I am out. But if you let a loss continue to grow and grow and grow and grow, you may lose all of your money and you are done trading. So thank you very much, Mark. You can follow Mark at Mark Minervini. And again, this all comes back to trading psychology, the skill of having the discipline to take a loss when your trade is invalidated. All right. All right, everybody. Let's take a look at the trade ideas that I'm looking for next week. And just wanted to mention again, everyone, I do teach private one-on-one lessons in the evening time via Skype. I have been trading for 28 years. I love to teach. I've taught people from all over the world at all different levels, from absolute beginners to completely advanced. If you would like to learn the skill of trading, take my course. I promise you, you'll be happy. You are going to learn so much. It's an investment in yourself. The cost is $1,750, but I promise you it is worth every single penny. I have a lot of students at the moment, but feel free to send me an email and, we can talk about maybe scheduling a lesson a little further out, maybe February or something of this year. But my email is in the link in the description, and send me an email and we can get started talking. Okay, Anheuser-Busch, Budweiser. Well, I am looking for a short. Why am I looking for a short? Well, look, you see the two orange lines here, 66.32, 64.80. This is the top and bottom of this order block. We had liquidity, we ran the level, we changed market structure dramatically to the downside in this area, in between 66.32 and 64.80, you're in this order block. This is a bearish order block. Doesn't mean it can't blast through it, but there's a very good chance that when it gets into this order block, it's going to fail and go down. Okay, let's take a look at some other things other than the order block. Look at the highs we had here. Very strong upward momentum with the green MACD bars. Then we pulled back into red, clearly. Now look, are we higher here than over here? We are. No green bars whatsoever. This is very bearish, everyone. This is called a double top with a bearish divergence. We also have a ATR divergence. Here we're like the 7th ATR. Now we're higher. We're not even to the 3rd. Look at the RSI. RSI way up here over 70. Now we're higher. RSI below 70. So we have a triple divergence, bearish MACD divergence, RSI divergence, ATR divergence. So just that by itself is very bearish, but I still need a trigger to get in the trade. My trigger will be if we have some kind of price action in this order block. Because again, the order block very likely, not 100%, but there's a good chance that once we get into order block, that's going to be it. You overlay that on the fact that we have all these divergences, makes me very bearish on Budweiser. By the way, I checked on Budweiser on Friday for some shorts. Short shares were not available at the time. And I have noticed in my experience, when you try to short something and you cannot get it, it's because there's not enough people are no longer on margin in here. Or in other words, when I can't get short shares, it usually means it's going down. So I can still buy puts on this if I can't get the short shares available. So next week I'm looking for some type of either one, rejection of this level, or two, some kind of reversal or V1 or something like that inside of this order block. And what will be my stop? It would just simply be a close over 66.32. That's it. If it just simply closes above, then it invalidates that order block that happened way back in the past. And of course, I'll have my my 2 ATR trailing stop level above. So this one really kind of is day by day. If I get a big rejection off of this order block, I would consider getting short there. If it just moves up into the order block, then I would wait for some type of reversal, V1, gap open, reverse, something like that. But anyway, somewhere next week in this area here is where I am looking to short, but I kind of have to wait to see what the price action is showing me. Again, rejection of the bottom of this order block, I would consider getting short, or some kind of rejection or reversal bar or V1 or a V2 at the downside in here is what I would look for. My stop would just be simply a close above 66.32. But there's a lot. This looks very bullish. I'm aware of that. But from a MACD perspective, RSI perspective, ATR channel perspective, order block perspective, right in here is where I'm looking to potentially get short. And by the way, what do I have? 6 symbols here. All of these signals may trigger at the same time. Does that mean I would jump into all 6? No. I always narrow on a day-to-day basis. I always narrow it down to the best setup out of the 6 if they were all to trigger. So what makes one better than the other? Well, confluence of signals, relative strength of the market. What does the longer term time frame look like? Not only am I going to be looking for signals on the daily, but I'm also going to be looking to the higher time frame on the weekly to see if I can see some kind of rejection. So, that's the devil's in the details, everyone, as far as, maybe you have 4, 5, 6 candidates. How do you narrow it down to the best one? The one that has the best risk to reward ratio, has the most confluences of signals, has the best relative strength, and their larger time frame looks better as well. And again, this is what I teach in my private one-on-one lessons, how to narrow down to pick the one that has the best report card, essentially, right? So Budweiser, somewhere a short between 64.80, 66.32. Really do like this trade, but again, I still need price action to confirm. FedEx. All right, here we go. Oops, here we go. FedEx. Well, I never hold through earnings because earnings can go up or down very, very quickly. And even if you have good earnings, sometimes the stock can go down. Even if you have bad earnings, sometimes the stock can go up. Just as a general rule, I never hold through earnings, ever. If I'm in the trade and it still tells me to stay in the trade, if that earnings comes, I'm just out before earnings, because our job as traders is really our main focus and our main goal as a trader, as a money manager, is to reduce risk and to be aware of risk. And the best way to put yourself into a difficult situation is to hold through earnings. So that's why I simply don't hold through earnings. And you can see FedEx, day before earnings, $278. Well, it's dropped $30. So would have been a good idea in this particular case actually to get out. But there are some interesting levels coming up here with FedEx. Very interesting ones. 200-day moving average, the black line. This is a good level to key off of. Next week, if we close below the 200 and then close back above the 200, I would consider getting long here. If we bounce at the 200-day moving average, I would consider getting long here. I drew this green line here. Look, see this down bar? Well, this is a bullish order block. Doesn't look very bullish, right? But this is a bullish order block. So there should be some kind of support at the high of this order block. So I draw it out in time here, and it's just over the 250. Ideally, if I get a rejection of the 200-day moving average, I would definitely consider getting long FedEx. But ideally, here at the 250 would be my optimum place, because the high and low of that order block are the important areas. And you can see how the 250-day moving average, the purple line, falls within that order block. So the order block is going to most likely add some support, or offer some support here, and it comes nicely. This 250-day moving average comes nicely tucked there. If we get down to this 250-week day moving average, depending on how quickly we go down there, we'll probably have like a 30 RSI, which would be perfect inside a bullish order block in the low 30s at a significant level to the downside, or the 250-week moving average. Right in here would be ideal if it gets there. Right there, it's blue, between 234.90 and 223.80, ideal place for good risk to reward ratio and lots of technical support. But again, I may consider taking the trade if we reject the 200-day moving average as well. It may not get down here. It may just test that 200 and head back up, so you don't know. So anyway, this is what I'm looking for on FDX, FedEx next week. India. Okay, I really like this trade, everyone. Earlier in the podcast, I was talking about abandoned babies. I was talking about order blocks. Well, you can see the highlighted bar. This is an abandoned baby, meaning it gapped up, boom, and then it's completely gapped down. Now, I have the orange line here at the bottom of the abandoned baby. If we get up here to 48.49, this is a order block too. Just ironically, this is an order block too. Right here at 48.49, I would get short India, INDA. I would place a 4 ATR stop to the downside, a 4 ATR profit target to the downside, and a 2 ATR profit target to the upside, just like I did on oil. And let's go back in time and kind of see what's happened with order blocks, with abandoned babies. Here was a bearish abandoned baby, because we gapped up, then we immediately gapped down. Was it correct? It certainly was. Look at this bullish abandoned baby. Gap down, gapped up. That's bullish. Was it bullish? I think it nailed it. So look, bearish here, abandoned baby, nailed that. Bullish abandoned baby, nailed that. And now we have a bearish abandoned baby as well. So I am definitely going to consider getting short INDA. I just need it to kind of go up and try to close that gap. Then I'll have a 2 ATR stop above, 4 ATR profit target below. CarMax. All right, well, CarMax, we moved up nicely above the 200-day moving average. Then we had earnings where it gapped way up, reversed back down. I would consider getting long CarMax, KMX here if we come down and test the 200-day moving average. A bounce, an intraday rejection, a close under, close over. This would all of these signals here, I would consider possibly getting long KMX. Shopify. All right, well, Shopify is a short. Back here on the 19th, we had an order block. Up bar. Wednesday, we changed structure to the downside. Now, if we get in between 79.70, 77.20, we are in a bearish order block. I would consider getting short there. And similar to Anheuser-Busch, look, here we have a high. Tall green MACD showing a lot of momentum. We pulled back to red. Back here on the 19th, we made a higher high. No green bars whatsoever to be found. Bearish, double top, bearish divergence. Here on the ATR channels, we got a little bit above the 5th at the high there. Now we're higher than that. We're only at the 1. RSI, way above the 70 here. Now we're higher, below the 70. So triple trifecta of bearish divergences. But just because you have all these divergences, you just can't go piling in there. You need a trigger. You need a reason to get in. The reason to get in would be this order block. So I would consider getting short here between 77.20, 79.90. My end of day stop would be taking out the high of that order block. And of course, I'd have my 2 ATR above there. Last but not least, UUP, which is the dollar. Well, what's coming into view here? 200-day moving average, 300-day moving average, 250-day moving average. We're getting into the 30 RSI levels. Now remember, the dollar at this point is negatively correlated with the stock market. The more the dollar goes down, the more the stock market goes up. Well, we're getting into some key levels here on the dollar that if we get a bounce, we're probably going to see a pullback in the market. And by the way, after we go through the potential trades for next week, I'm going to talk a little bit about just the markets in general and kind of what I think will be happening in the near future. But nonetheless, UUP dollar, I'm looking for some kind of rejection of the 200, the 30 RSI, the 300-day moving average, and or the 250. And of course, rejection of multiple moving averages along with potential V1s, V2s, maybe an under 30 over 30. Just noticing here on this chart, we have a bullish divergence. Look at the low here. Look how deep the red bars are. We rally into green. Now we are lower here than we were over here. The depth of the negative MACD momentum here, even though we're lower, is not as deep over here. Basically means we're probably running out of sellers, and the implication is that we would be going up. So all of this stuff dovetails with looking at the indexes. They're having a lot of negative divergences, dollars having bullish divergences. That's why I think we're very close to a short-term top in the market. So UUP, some kind of rejection of the 200-day moving average. Ideally, if it came with the V1, V2 would kind of help improve the case. An under 30, over 30 in addition to that would also be improved. But yeah, I'm looking at potentially getting long the dollar. So real quick recap, Budweiser, I am looking for a short somewhere in the order block between 64.80, 66.32, looking for a short, especially with all these divergences. FedEx, looking for a potential long with the rejection of the 200 or the 250-day moving average, one of those. I would ideally prefer the 250 because it falls within the order block back here on the 26th, but looking for some kind of potential long on FDX. India, I'm looking for a short if we go back up and test the bottom of this abandoned baby here at 48.49. CarMax, looking for potential long at the 200-day moving average, the black line. Shopify, looking for a potential short in the order block somewhere between 77.20 and 79.90, especially in context of all these bearish divergences. And then last but not least, again, dollar looking for some kind of rejection of the 200-day moving average and overlay the double bottom bullish divergence here. So those are the dailies. Now on the weeklies, I only have one, and it's VIX. I thought I was going to be able to get into VIX this week, but it didn't trigger. It just didn't trigger yet. But very important here on the VIX. VIX's volatility, it's usually negatively correlated with the market. Look at the lows. These are weekly bars. Look at the low here. Look at the low here. You draw that line out into the future of that channel. Look at that. We basically got exactly to the bottom of that channel and bounced. There's a lot of things I like about VIX. Look, we're at 29.36. If this would have closed above 30 RSI, I would have gotten into the trade because there's so many bullish things about this. Look, here we have lows, red MACD. Here we're much, much lower, no red MACD. Here at these lows, way under the 30 RSI. Here we're much lower, we're still under the 30 RSI, but not as deep. Here at these lows, we're at the negative third ATR channel. Here at these lows, we're only at the negative 2 ATR channel. So there are all sorts of bullish divergences happening here. We tested the trend line channel to the penny before we bounced, but I still need that bullish signal, and the bullish signal will be us closing above the 30 RSI. If we close above the 30 RSI, especially with all these bullish divergences, I am in. So that's really all I have on the weekly is the VIX closing above 30 RSI next week. Now, I think we are short-term very overbought on the indexes. VIX here, everything about this is bullish, so the implication is VIX is going to go up. If VIX goes up, the market's going to go down. And if we look at last week, what happened on Wednesday, I think it's very important, everyone, to kind of take a look at this. On that big move down on Wednesday on the 20th, we changed market structure to the downside. Here we have a level of liquidity. We ran the level of liquidity here. This bar here changed market structure to the downside. Yes, we've gone up since then, but still this day here on the 20th is looming. There was a lot of volume. It was a big selling move down, but more importantly, it was showing you that this market can go down. The sentiment, the psychology that happened on Wednesday was a game changer. So it just showed that, yes, I know this market seems like it's never going to go down, but to me, that was a defining day. That was a defining moment that things may have possibly changed. So that compared to what's going on with VIX, with the dollar being so low, TLT, which are bonds, starting to, we've had this historic move up in bonds, but now we're kind of starting to lose some of these moving averages. So bonds are overbought right now. If bonds head down, most likely the stock market's going to head down. Most likely the stock market's going to head down. VIX is going to head up. So yeah, be very careful. There's a lot of warning signs here, especially with what happened on Wednesday, that we may be at a short-term top. So, like I was mentioning before, if you found something helpful in this podcast today, I really would appreciate it if you could hit the thumbs up button. If you are interested in taking my one-on-one course, I promise you're going to learn so much. It's a 15-hour total, 5 sessions. Each session is 3 hours, so it's a serious course. But I have a lot of students at the moment. But if you'd like to reach out to me, we could get something scheduled for maybe something in the future. Please try to go out and do something nice for someone today, everyone. If we all did one nice thing every day, it really would make the world a better place. If you could also go out and do one nice thing for an animal, would really appreciate that. One nice thing for a human, one nice thing for an animal, it would just make the world a better place. All right. And again, I have my online course. The The link's in the description of the video. It's a great course, super affordable. So lots of resources out there for you. You can see other resources on my YouTube channel, other lessons that I have as well. But I really hope that you have a really nice, peaceful, blessed holiday coming up this next week. A great new year. I wish you all the best for the new year. Health, wealth, happiness, all the important things in life. And if you have any comments or questions, please feel free to leave them in the comment section. I'll do my best to get to them. And then God willing, I will see you next week and we will discuss what's going on. But please be careful, everyone. Like I said, my professional opinion here is that we are a lot more likely near a top than a bottom. So keep those stops tight. Get yourself a process. Follow the process. And I will see you next week. All right, but have a great Christmas, have a great holiday, or whatever it is that you celebrate, and really appreciate being here and spending the time. And then on the way out here, I have to run the U.S. legal disclaimer. Thanks a lot, everyone. Talk to you soon. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.